Well, Telus reported earnings and sales that trailed estimates for the third quarter last week, and the stock has now gained its only sell rating on Bay Street as a result. We're joined now by Liam Gallagher, analyst at Veritas Investment Research. Liam, thanks very much for joining us.
Pleasure to be here, Roger.
And you're the only one. Why is that?
Yes, I am the only one. So we really have concerns around Telus's dividend and the sustainability of Telus's dividend. So Telus reports its payout ratio on a cash basis, but in reality, 2/3 of Telus's dividend is paid out via cash dividends, and 1/3 is paid out via the dividend reinvestment plan because they have a 2% discount on the DRIP. When you look at their whole dividend obligation, their payout ratio on a trailing 12-month basis is more like 150% versus 100%. Now, Telus is also looking to remove the discount on the DRIP because it's very dilutive. So, it's a 2 to 3% headwind to free cash flow per share growth, which you can't have in a telecom market growing 2 to 3%. But then Telus needs to come up with about $800 million in incremental free cash flow. So we don't think that, we think they really need to thread the needle here, essentially. And it trades at a premium to Bell and Rogers, and we don't think that's warranted given the company's financial position.
And you're not thinking it can thread that needle then?
I mean, there's a chance they definitely could. So we estimate the payout ratio by 2028 will be around 100%. Assuming capital intensity falls to 10%, you get 3 to 4% EBITDA growth. So maybe they get it to 90 or 95%. But then you're left with a company that generates about $200 million in excess free cash flow after dividends and can barely deleverage organically. And Telus pays a lot of interest. Interest expenses almost doubled in the past 5 years. Debt has increased by $7 billion. As well, what we've seen this year is them access hybrid debt markets to pay down some of their existing debt because rating agencies only treat hybrid notes they give them 50% equity treatment. So the whole principal doesn't count towards their debt balance. But those come at a cost. They're issued around a 7% rate, whereas their existing debt average cost of debt's around 4%.
And you're worried they're digging a hole, that they're in the hole?
Yeah, absolutely. And that's one of the problems. Telus announced that they increased the dividend 4%. In reality, dividend growth will actually be 5 to 5.5% because when you're issuing all these shares to the DRIP, it amplifies dividend growth further. So for some perspective, over the past 5 years, Telus has grown their dividend around 10% annually, total dividends declared, whereas cash flow from operations has only increased at a 1% compound annual growth rate. So, that doesn't add up to having a sustainable dividend.
And let's talk a little bit about some of their plans. You're also worried about the AI, where they want to go with that. Was that $800 million? Is that what's earmarked for AI for this year?
So, they announced that they generated $800 million in AI revenue this quarter. I mean, we hadn't heard about this revenue in prior quarters. So it's kind of vogue right now for companies to say what they're doing with AI. A large part of that's their data annotation business with Google is their primary customer there. And revenue from Google has declined 15% year over year. And that generates about $500 million of the $800 million we estimate today. And then they're getting into AI data centers. So basically renting out compute. We like that they're doing it in a modular approach. So, if supply and demand dynamics shift, they're not going to be left on the hook, and it's within their capital intensity guidance, which is good. But when you look at returns on incremental capital at Telus over the past 5 years, they're negative 2%. So we think investors should be skeptical whenever they go out into a non-core area other than telecom.
Now, any worries if they go with this modular format that they might be left behind as well, with some of the bigger players?
Yeah, potentially. I mean, they're a telecom company running data centers. They do have a competitive advantage with the sovereign nature of it, where we could see them winning government contracts that want to keep it within Canada. But, there are data center providers. I'm not an expert in the space, but, that's their core business. So to assume that Telus could run it equally as well, I think is a bit of a stretch.
Okay. And just on a bigger picture, you've got Telus as a sell, Rogers as a buy, and BCE, which is our parent company, of course, on a reduce. That's quite you've run the plate there.
Yeah, actually, we have Rogers. I downgraded it to reduce because we don't see much upside. We liked where Rogers was at, and we think MLSE is on a go forward basis, it will create value, but we do think they probably should have paid down debt, but we think it trades out around its intrinsic value. Bell, we see some upside from the Ziply acquisition on a go forward basis, but the capital allocation track record there isn't phenomenal. So we really want to see tangible evidence of them executing before we recommend shares. And then we've liked Quebecor because, they have the lowest leverage, they have the lowest payout ratio, they're buying back shares, they're in the best financial position, and they've benefited from wireless competition.
And I was just looking at they're all up. Actually, they're all up today. I was just taking a look at how they were trading today. All of them are up. BCE's up 1.99, Quebec more 1.59. Rogers is up, as is Telus. So they're having a good day right now. But you think caution down the road?
Yeah, I think caution. I think Rogers and Bell will be fairly stable. I think Rogers and Bell will be fairly stable. I think with Telus, I just see risk there. I just see financial risk. If you're going to own a telco, one of the incumbents, I would recommend Rogers or BCE, and just Telus, they really have to thread the needle. And if the economy deteriorates, they're definitely more exposed to risk. There's not as much of a margin of safety there.
Okay, Liam, thanks very much for joining us.
Yeah, thank you for the time.
Liam Gallagher is an analyst at Veritas Investment Research. And again, one last reminder, BCE is our parent company of BNN Bloomberg.